there's an ongoing joke that if you look at people's hairlines, you can tell whether they're value investors or not. And I mean, my things are pretty much pulling back very strongly. So yeah, well on my way. Not the best value investor, but I do understand the principles, and I'm going to discuss that with you today. So firstly, I just wanted to let you know that this is not financial advice. I'm an analyst, not a financial advisor. So I'm giving you research inputs, and I'm using empirical data because I'm passionate about my views. Unlike crypto investors, you know, they really piss me off. All right, so just to give you guys a bit of history, value investing is considered one of the world's first structured investment strategies. I think it's been pivotal to the investment universe, and it was initially introduced by Benjamin Graham through the Intelligent Investor. I would too like to consider myself as an intelligent investor. That was in 1973. I do have the book. If anybody wants to borrow it, hit me up in my DMs. I'm happy to share. Just don't hit me up with some crypto advice because I'll be very pissed. To take it on further, if you look at some of the academic papers that have been released, I think the most pressing ones would come from Eugene Farmer and Kenneth French, but I will touch on that a bit later when we come to the asset pricing models and also the efficient market hypothesis, which I'm sure if you have very basic finance understanding, you would catch on to that very quickly. But I'd just like to take a little break and take a sip of this Tafel lager. Namibian brewery is well fucking done, eh? Really cool company, and I think it should be looked at, especially if you're an international investor. We need some foreign direct investment. Namibia is dry, literally, figuratively. It's very arid. Anyways, I digress. I think it's also very important to recognize that there are very nuanced differences between what you call pure value and the value investing style that has been brought forth by Benjamin Graham in The Intelligent Investor. So pure value investing would literally be purchasing stocks on a valuation multiple that would be considered very low. So if you look at your price to earnings ratio, price to book, basically any ratio compared to your price, right? So you want it to be cheap. That's a value investment. So you can literally go onto your exchange and you can look for the cheapest stocks in terms of your PE, PB, price to free cash flow. But what I would suggest is rather looking at something that was very similar to what Benjamin Graham actually proposed, which is looking at companies that are relatively profitable but are cheap at the same time. So they're undervalued. And I think that little nuance really completes the picture because I can tell you now from personal experience, I've been talking to a lot of people and I tell them, yeah, I'm actually interested in looking at, I'm not saying investing into it because I can't give you advice, but I'm looking at companies like Alibaba, Tencent. These are tech companies in Asia, and a lot of people are saying these are growth companies. No, they're not. They're very cheap in terms of what you can get out of them in earnings or dividends or growth. So what you're looking at is you're looking at a cheap company. That's a true intelligent investor, value investor that is. And then just to move on to give you some more color around the intuition of the premium, which if I refer to the value premium, it's basically the returns you make on the back of investing into value stocks. And the intuition is very basically, so if you invest into a stock, right, and it's cheap, it's most probably cheap for a reason. So let's look at Alibaba or Tencent, right, being cheap. These companies are cheap mainly because there was a serious and stringent lockdown from the Chinese government restricting students from playing on these on their applications, etc. So you've basically lost potential clients. When these clients reach the age of 18, they're probably not going to be in the system. They're going to move on to PlayStation, whatever it may be. So the market has punished these stocks for it. So it's cheap for a very good reason. So if you think about that intuitively, if you want to win as a value investor, what you need to do is you need to take the risk that this stock is very cheap, and you need to do your valuations on the back of that. You can do a free cash flow to equity valuation. You can do a price to book, price to earnings, relative valuation, whatever it may be, whatever floats your boat. And then you need to commit. You need to have conviction. So after you get your conviction and you're in it, man, you're going to put your house on it. You're going to be a value investor by heart and by spirit, right? What you expect to happen would be that the market has mispriced it. So when the market sees that these companies are actually making profit at a rate higher than what was expected, then because the market is so efficient, it's going to recalibrate very quickly, and you're going to make your money because you've taken that risk. So in finance, or rather in my personal ethos, I do see risk and return as two sides of the same coin. So every risk you're taking, you're going to get a potential return for that. So now to get a little bit more technical, so just bear with me, I'll try and make it as simple as possible. I'm going to move into the efficient market hypothesis and also asset pricing models, which I find very interesting. So just to give you some insight onto the efficient market hypothesis, it's basically a very basic principle, and I think it's a really cool principle because if you can understand this principle, what you can do from here is you can use it as your primary, I guess, principle, and whatever new idea you get, you can plug into it and see if it relates to it. And that's how I navigate the financial market space, right? So a capital market, I would say, is said to be efficient if it fully and correctly reflects all relevant information in determining a security's price, whether that be a stock or a bond. And it was introduced by Eugene Farmer. It's like, look him up and you're going to see the hairline. He's a bit shorter than I am, but I'm telling you, have you ever thought about, like, just to digress a little bit, I like digressing and I hope you don't mind, but if you ever had to fight somebody, right, in a club, you're having a couple of shots, a couple of beers, things are getting rowdy. If you see a guy with a cauliflower ear, like Habib, I'm going to edit it in somewhere, right? You're not going to fight this guy. Why? Because it's a telling sign that you're going to get your ass whooped, right? So if you ever see a financial guru, an economist, an academic who's bald or has a receding hairline, trust me, he knows what he's doing. That's the guy you want to work with. So that's Eugene Farmer. Gene, I hope you're not too mad at me. And I hope you see this, actually, because I'm a big fan of yours. But he introduced the concept in 1970. And the way you test it is through event study or portfolio study methods. So if you can prove that you have some type of an investment strategy that you can pull off and actually beat the market, that's how you beat the efficient market hypothesis. Now, it's important to note that we're pragmatic. We know that markets are not efficient all of the time because people do make money. I mean, even these crypto goons make money. They make like 200% in a year, but they can't determine what the risk is. But anyways, so it's impossible for a market to be completely efficient, but I do think it's a little bit more efficient than people think. And I will touch on that a little bit later, but that's how you test it. And what happens after your event study or your portfolio study, you will then examine the excess returns with respect to the information, specifically information events. So it could be dividends being released or somebody telling you that, obviously it has to be public information because if it's not, it's illegal, but if somebody tells you that this company is going to grow its revenue by 50% because they have this new crazy product like the iPhone or the iPad, whatever it may be, what happens is the market will recalibrate this information and it will be placed into the price, right? So portfolio studies, as an extension to that, they entail actually building portfolios with idiosyncratic characteristics, which will in turn be compared to expected returns from a specific asset pricing model, which brings us into the next step, right? As a little disclaimer, there's a little bit more that should be added to the efficient market hypothesis theory, as it's weak, semi-strong, and strong forms, but I think that's a little bit boring, so I'll leave that to you. You can read that up if you want. So I'm going to move on to the capital pricing segment. All right, so in this next segment, I think it's paramount, not important, because paramount is even more important than important, right? To introduce the synergy between the efficient market hypothesis and basic asset pricing model. So not to go too deep into the history, the first one was the capitalized asset pricing model. It, on a very basic level, just covered the risk and volatility from the market that you invested into. So it'll basically tell you exactly how much risk you're taking and whether your returns beat this risk on a risk-adjusted basis, right? And then it's quickly been disproven in academia, right? So Farmer and French, Eugene Farmer, Kenneth French, they released the three-factor model in 1993. I'm not going to get too technical, but I'll leave the links if you do want to get technical. You can read the reports, and I'm pretty sure if you're in finance, you do know these reports. They're the holy grail of finance. Eugene Farmer is actually considered to be the founder of modern day finance, as he says. I say finance though, but whatever. So the three-factor model in 1993 would then it would explain your returns with three different points. The one is, if you want to beat the market, it's probably due to you're investing into small cap stocks because there's an excess return, or value stocks, so it's your high versus your low value premiums, and then basically the market. So if you just go and you buy stocks because they're cheap based on your price to book, price to earnings ratios, then what happens is this three-factor model is going to capture that return, right? Because it's you're not doing anything special, so you're not going to be able to go to a client and tell them, hey, I gave you guys 15% return, because if you test that against your three-factor model, it's going to show a 15% return as well, because you did what the model did, and there's nothing special in that. You're not an active manager. So if you're going to beat this, you need to do something that's not being captured by this model. But just to take it on to the next step, in 2014, Gene Farmer and Kenneth French actually released a 5-factor model, which allowed them to add in the profitability factor and investment patterns factor, which basically means that if a company is more profitable, you should expect higher returns. And also, if a company reinvests their profits into the company, you should expect higher returns as well. If you think about Apple, I'd rather have Apple reinvesting into themselves as opposed to paying me a dividend, right? That's the very basic understanding of it. But this puts us in a very difficult space. It's quite the conundrum. Testing your investment process against a 5-factor model. You're not beating the model on a risk-adjusted basis if you invest into size, value, profitability, or their investment pattern. So as an active investor, you really have to do something extra. So after all of that, it does sound like I'm actually against value investing. So I'll have to make that very clear that I'm not. I think everything is very cyclical. I've actually published my own paper where I tested the value premium by using Fourier analysis, and I will put it in a link below because I need the views. People do look at how many people view and cite your paper, so I must say it's called advertising. So sorry if it annoys you, but I think you'd enjoy the read. Strategy can outperform these asset pricing models, right? It provides you with abnormal returns, and then you can justify being an active manager and actually charging fees to clients. Otherwise, they could have done this themselves. They could have gone into the Excel, get the data, sort it, and invest based on those matrices, right? So in other words, you're unlocking value and you have a strategy that is robust, or in other words, an anomaly to the efficient market hypothesis. Now, let's bring it back to value investing. Historically, value investing has always beaten CAPM and the 3-factor model. Unfortunately, it did not beat the 5-factor model, right? Because profitability and also the firm reinvesting into itself basically started speaking towards the value premium. So it's weakened over the 5-factor model's implementation, for lack of a better term, right? But Cliff Asness actually released a paper. I can't remember the date, but I will plug it in the bottom. And he showed that if you mix your value premium with the momentum, or your value investing style with the momentum tilt, you do beat the market and value becomes alive again, right? I'm going to link all these plugs 100%. Cliff Asness is a G. I like him as well. So value investing is very much alive. And what I think is what happens is it changes over time. Like any other thing in this world, everything is time dependent. If you were an investor before the telegram was invented, your market was going to be completely different as soon as the telegram was invented, because now people could communicate, information was more freely available, and that would just change the dynamics. And that's what we're seeing currently, especially with value investing. And so your main question is going to be, why value investing now? And I'm going to answer that. So Cliff Asness actually introduced this idea. Well, it's not Cliff Asness, it's his firm, AQR Capital. Shout out to you guys. They introduced the value spread. And it's basically a tool that shows the relative cheapness of value stocks compared to historical standards. So what's very interesting is you do see a similarity between the contrast between growth and value stocks between the year 1999 and 2000 and what we're seeing currently, right? Which we all know that was a bubble. And I mean, everybody's talking about how this is going to be a big bubble, the market's overpriced, blah, blah, blah. Bubble boys all around. But there's a very big difference this time. If you look at the companies in 1999, in the year 2000, those companies didn't have the same robust balance sheets and also cash generating capacity. If you had to correctly price a company like Apple 10, 15 years ago, you were probably going to have to assume that every person on this planet has like 3 iPhones, right? You're going to be laughed out of boardrooms. But they do. Right? They don't have an iPhone, but they have an iPad, they have a laptop, they have Apple TV, they have Apple Pay. Like, these companies innovate, right? So just in terms of value stocks, I think it's paramount to look at your current prices of stocks, and especially now with interest rates that are probably going to go up from the Fed. They've mentioned that very stringently. And also inflation being a big threat. I think a lot of stock companies are going to become cheap, but I'm not telling you to buy, hold, or sell. Like I said, I'm not your financial advisor, I'm an analyst. I'm just speaking about what I'm thinking, right? So I would be very careful to discount a lot of these tech companies based on the fact that macroeconomic fundamentals are going to change. In fact, we don't even know if the Fed will actually hike interest rates. They're very much political, and there's a lot that goes into that. So as a bottom-up investor, I'd be very careful. I would look at whether I can find a good price in terms of what I'm expecting in earnings, or what they have on their book, or even what they can produce in free cash flows. So I think value investing is very much alive. It's around, and it's proven to work. It's one of the oldest value investing styles. I think over the last 5-6 years we've had a bit of a beating, but I think going forward it's going to bring a lot of order into your investment process, and it definitely has brought some order into mine. And I'm looking at discounts, and I do think that prices will recalibrate as soon as the macroeconomic fundamental threats basically disappear, and people start seeing the profits coming through, or dividends, or whatever it may be. Specifically looking at Alibaba and Tencent, as I mentioned earlier, if you think about inflation or interest rates, that could probably be a part of our lives for 3 years. But if you're talking about a tech company, what are they going to do in 15 years? What are they going to do in 10 years? And as an analyst, it's your job to actually price that and predict it, and not many people can. So keep your head on your shoulders, be calm. Do recognize that the value spread, as I mentioned earlier, is actually at 16 right now. That's about 50% larger than the last peak. So I do think value stocks are extremely cheap, but I also do think it's important to just make sure that your analysis is proper, and that you can actually predict the future incomes, and that you have companies with strong moats. So basically barriers to enter, a very strong brand positioning, very low debt, and cash generation capacity. And yeah, that's me.